Big one this morning continues to be Paytm and what has happened with it. The parent company, One97, reported a net profit of 123 crores for the quarter ended June 2025, marking its first profitable quarter across key financial metrics. Let me go across quickly to Harsh. Is this an optical illusion or is there really a turnaround, Harsh?
It's clearly a turnaround, frankly speaking. Tamanna, good morning. Let me first take you through the top 5 takeaways. The top line growth was muted. It wasn't as good as anticipated. And I'll come to the expectation versus the reality. They've turned both EBITDA as well as PAT profit. That's largely on the back of operational efficiencies which are playing out in the business. They're also saying, and this was new, no mention of the word adjusted, and Mr. Sharma was extremely proud of that as well. He said, we won't be using adjusted anymore and expecting margin improvement going forward as well. We'll talk a little bit about commentary. Now let's talk about the numbers itself. There you go. The 1917 crore top line number, which grew just about less than 0.5% on a QOQ basis, was expected to grow by 3% on a QOQ basis. So maybe a very, very marginal miss, if at all I can call it that. But look at the EBITDA number, 71 crore versus the 18 crore number which was anticipated. That's a sharp beat. The margin has come in at 3.7% versus 0.9%, which was also a sharp beat. Other income has grown by around 8% on a sequential basis. That's important to understand only because EBITDA cannot be larger than PAT typically, but because of that other income number, it is. And profit after tax has come in at 122 crores. So just to kind of contextualize that, let me quickly take you also through what has led to this profitability. And let's look at the larger numbers here. You see the employee expenses come down by around 100 odd crore. You see marketing spend go down by around 40 odd crore, and you see a 20 crore increase in maybe revenue. So those are the key metrics. Other costs coming down by 89 crore, and that's what's led to this very, very sharp increase of 143 crore in profit in terms of EBITDA profitability. Let's focus on the larger numbers now. In terms of the differential in EBITDA last quarter versus this quarter, it's a 150 crore differential. The largest chunks of that is coming from employee costs as well as other expenses. You join the two and you largely have that 150 crore. So marketing spends coming down, which is in part of other OPEX. Marketing spends down 30% QOQ. And then you have employee benefit expenses, which is also down around 40%. On a YOY, 33% on a YOY basis. So those are the key pieces that one needs to understand. In terms of other metrics, also improving. Gross merchandise value up 5.4 lakh crore. That on a percentage basis gives top line to Paytm. Financial services revenue also inches up. The contribution is now at 29% versus 28.5% on a sequential basis. Merchant base has grown by around 6 lakh merchants, which is again 5% up QOQ. All of these are metrics through which they grow. So important to understand. And their cash balances have gone up by 63 crore. The cash balance now stands at 12,870 crore for a Paytm. So not only are they PAT positive, they have a huge amount of cash lying on the balance sheet. That is the 5-quarter journey. And I want to quickly take you through the con-call commentary. And you look at the revenue growth from 1,500 to 1,900 crore, but look at the PAT. It was negative 840 in Q1 FY25, now positive 123. Last off, top 5 on the con-call takeaways. They're striving towards 15 to 20% EBITDA margin. FY26 exit EBITDA margins to be considerably better than what they've clocked currently. They believe the payment business is profitable even without MDR. Indirect expenses should not grow anywhere close to revenue growth. So that's going to be the lever for EBITDA. Consumer credit business has likely bottomed, so you'll start to see growth there.
Okay. Now, before we analyze the numbers with Sachin Dixit of JM Financial, let's just hear what Vijay Shekhar Sharma has said in the conference call. He believes that the payment business standalone can be a profitable one.
I do believe payment is profitable business. Like you're seeing, without UPI MDR, we are talking profits. And I do believe payment standalone is profitable and has a operating leverage. We continue to push operating leverage of creating more solutions and value adds on top of as basic as processing, if you will. And that's where the differentiation in the payment business comes. I continue to believe that payment standalone will be bottom line driver and a large bottom line driver once these MDRs also show up. In effect, today we are calling break even, and tomorrow we are going to call large profit from payment. And that's why I keep saying, focus on the core, we have a great business.
Focus on the core, we have a great business. Well, that's the day for Vijay Shekhar Sharma to say it. Sachin Dixit, lead internet research analyst at JM Financial Institutional Securities, joining us this morning to break it down. Sachin, are you feeling the optimism that Vijay Shekhar Sharma is portraying in that conference call as far as 197 is concerned?
Vijay is generally a bullish guy anyways, so I will not doubt that. But largely, I think the optimism can be felt just in the stock movement that we have seen in the past as well. The stock has been quite an outperformer in the recent past. And thanks to this result, I think that outperformance could sustain because the company has not just given a good result. They have also been quite bullish on the commentary. They have talked about the fact that their contribution margins are going to be healthier going ahead. There's obviously immense operating leverage in this company at almost like 55-60% contribution margin and the revenue growth of close to 25 odd percent. That's a huge operating leverage that you can drive in a business. So which is the primary driver of profitability, right? As Harsh was showing some time back on a channel wherein basically how PAT had moved in the last 5 quarters is largely a function of that operating leverage being visible at 55-60% contribution margins.
So, hi Sachin, morning. The question then is that last point that VSS said in that bite that we played out, what we took from the conference call, that he's calling break even and going forward he's talking about a much larger profit. The question is visibility. When does that come in your opinion? And what will give you the confidence of that taking place? What are the metrics that you will need to see in Q2 and in the rest of the financial year for that to take place on a sustained basis?
Sure. So I think overall, when you think of that payments business being break-even to moving to higher amounts of profitability, a lot of it is going to be driven by the value add that the company is driving, right? Or a large part of that payments business is UPI, which is not yet monetized without any MDR on UPI payments. Right. So without that, basically the company has a large subscription revenue wherein their devices are like top of the street. And they are getting good amount of traction. Thanks to these devices, the company is able to cross-sell their loan products. They are able to cross-sell fraud detection and other services to their customers as well. So all of that combines to give you a large revenue pool. But I think a big boost to this revenue pool will need to come from UPI MDR in case it comes whenever it comes. I personally of the camp that UPI MDR is more of a question of when rather than if, because there is a pure play business case of why MDR should be there, right? There is obviously right now you see large offline merchants as well as online merchants. They are taking payments via credit cards, debit cards, where they are paying a lot of MDR compared to what is being, proposed on UPI. Right. So there is no reason for the government or the ecosystem to subsidize these large offline and online merchants in terms of their UPI transactions. So which is why I believe there's a business case of UPI MDR to come. Obviously, it's in the hand of government, how they want to bring it or when they want to bring it. But I think when it comes, it can be a very sharp driver to Paytm's revenue and profitability both.
Sachin, very quickly, it trades at what, a 30% discount to PB FinTech. Is that the right way to look at it? Do you reckon that could narrow?
I think it should narrow. After all, both the companies operate in segments which have longer term tailwinds. Right. Insurance obviously is an under-penetration story in India. Payments again, right, assuming that India is roughly a 11-12% nominal GDP growth story, payments businesses will continue to grow slightly faster than that.
So Sachin, sorry, slightly stretched on time. So assuming that it opens slightly higher, and by the way, thank you for the explanation. It's been lovely talking to you today. But if it opens up slightly higher, right, 4, 5, 6%, whatever it does an eternal of yesterday, would you still be a buyer?
So I recently, like last night, I published my note. I have a TP of 13-20 rupees on this name. So in that sense, obviously, I remain bullish on this name. Obviously, there could be like a short-term profit booking sort of things can come up if the stock has run up quite a lot in the recent couple of weeks. So can't predict those technical things, but in a longer term or slightly medium to long-term perspective, I remain bullish on this name.
Okay, so bullish on Paytm buy at these levels. Thank you for that, Sachin. Would have liked to talk to you more, but we're completely out of time. Maybe also talk about how AI has led to operational efficiencies. I thought that was a very interesting comment coming in. And is that a change that we're seeing. Sachin Dixit there of JM Financial saying that this is a well-deserved turnaround and you will see an upside on the stock today. Watch out for Paytm, up in mid-teens in the last 1 month as well.